Well, thank you, Tim, and to the IAF for the opportunity to participate in this Washington Policy Summit. Before we begin our conversation, I'd like to share a few thoughts about the outlook for the economy and monetary policy. The U.S. economy is in a good place, and it's operating close to both of the Fed's dual mandate objectives of maximum employment and price stability. Real GDP rose about 3% last year, and in July, the current expansion will become the longest on record. The unemployment rate is near the lowest level recorded in 50 years, and average monthly job gains have continued to outpace the pace needed to provide jobs for new entrants to the labor force. Average hourly earnings are showing a welcome increase consistent with a healthy labor market, and yet inflation remains near our 2% objective. All that said, the incoming data have revealed signs that U.S. economic growth is slowing somewhat from 2018's robust pace. Prospects for foreign growth have been marked down, and important international risks such as Brexit remain. U.S. inflation, as measured by the PCE price index, the core PCE price index, has been muted. And some indicators of longer-term inflation expectations remain at the low end of a range that I consider consistent with our price stability mandate. The considerations I just mentioned have led most forecasters to project that growth will continue in 2019, but at a somewhat slower pace than in 2018. At the Fed, in our most recent summary of economic projections, the median participant on the committee projected that in 2019, GDP growth of 2% will be the modal or most likely outcome. That core PCE inflation will rise to around 2%, and that the unemployment rate perhaps may fall a bit further to 3.7% by the end of the year. Now, again, these are modal outcomes, and of course, my colleagues on the committee and I should, and we do, factor in risks on either side of these projections in our policy deliberations. Let me talk now about monetary policy. Given the outlook for the economy, we decided at our March meeting that the current stance of monetary policy is appropriate. The funds rate is now in the broad range of estimates of neutral, that is, the rate that tends neither to stimulate nor restrain the economy. Our baseline economic projections see economic growth for the year as a whole running somewhat above the committee's median estimate of its longer-run trend, and see core PCE inflation remaining near our 2% objectives. For these reasons, we have indicated that we can be patient as we assess what, if any, adjustments would be appropriate to the stance of monetary policy. At our March meeting, the committee also released revised balance sheet normalizations, principles, and plans. And it announced that the committee intends to slow the runoff of our securities starting in May and to cease the runoff entirely in September. This decision is the culmination of discussions that we've had over the previous 4 meetings about our operating framework, and it reflects our desire to converge to a balance sheet that is no larger than it needs to be to conduct monetary policy efficiently and effectively. In September of this year, reserve balances likely will remain above the minimum level, including a buffer that is consistent with this goal. In this case, we anticipate that we will hold the size of our balance sheet at the level reached in September for a time thereafter, and allow the gradual increase in other non-reserve liabilities, such as currency, to slowly shrink the level of reserves. Importantly, with this decision on the size of our balance sheet now taken, we can turn our attention on the committee in future meetings to discussing and deciding on the ultimate maturity composition of our portfolio. Finally, as you may know, last November, the Federal Reserve announced that in 2019, we are undertaking a system review of our monetary policy strategy, tools, and communication practices. Information about this review can be found on the Fed's website. In this review, we will listen to a broad range of stakeholders at public events held around the country, and we will draw on their insights as we assess how best to achieve and maintain maximum employment and price stability in the most robust fashion possible. Taking these viewpoints on board, the committee will begin its own discussions this summer on how we might refine our framework, and we will provide a public assessment after the review is complete next year. Thank you, and I look forward to my conversation with Tim. Thank you.
Thank you. You know, in the music industry, you'd be described as a triple threat. You write, you perform, and you sing. So you throw in a PhD in economics, that's a quadruple threat. I don't think we've ever had that on stage before, so we're happy to have you. You mentioned the review. Why do you need a review? What's wrong with the current system that needs to be reviewed or potentially fixed?
Well, Tim, thank you for that. Let me just say up front that we and my colleagues believe that our current framework has served us well. That said, we think it's prudent, especially at a point when we're very close to our dual mandate objectives and when policy rates are in the range of neutral, that it makes sense now to take a step back and see if there are ways that we might refine and evolve our framework, in particular to reflect the world that we're in today. The existing framework was put in place in 2012, and there are a couple of differences between today and then. First example, I think we're all more aware of the possibility that the global level of riskless rates is lower, the so-called new neutral. I think that's more understood now, and that has important implications, obviously, for the way we think about policy being robust over the cycle. But let me be clear, we think our current framework serves us well, and the outcome of this may well be an evolution, not a revolution. But Chair Powell and the committee agrees that it makes sense to do this now. And I should also say that it makes sense to do so in a very public fashion. You know, we don't have a monopoly of wisdom. We're holding these listening events around the country. I did one in Minneapolis a day or so ago. In Dallas, we've got several more. And of course, in Chicago, we'll be having a streamed public conference on our framework. So we're in this process not only to deliberate among ourselves, but to listen to a lot of folks about that.
We had the chair of the FDIC on this morning. She's driving around the country. She's driven through 22 states. Are you driving across the country? Is this a Fed road show where you...
No, we haven't rented out the big Jimmy Buffett bus yet. So we're, I'm doing this on Delta Airlines, but so far so good.
So what are you hearing? You're in Minneapolis, your other cities. What are you hearing from the front lines of the economy? What are people concerned about? And how do they think about the central bank? Is it any different than what they've thought about it in the past?
Well, I think there are a couple of things. And again, we've done 2 of these events, Tim, and I'd say a couple of things. First of all, what we're really hearing is that there are real benefits to having a fully employed economy. Unemployment now is back at levels that prevailed when I was in 6th grade, so it's been a long time. But there are a lot of benefits to that. We haven't spent a lot of time with an unemployment rate before 4%. And folks are saying, I'm getting a job, I'm getting a raise, inflation's at 2%, so that's registering. We're also really hearing that there are many groups that traditionally lag behind in labor markets that are doing well now. They're getting a wage increase, especially workers with less education and in different ethnic groups. And so we're hearing a lot about that. And then just in general, by getting around to different parts of the country, you also get a perspective about some of the challenges that folks are facing in a big country. So I think it's very beneficial to us.
Is there a set of expectations either out in the country or here in Washington that you have tools and capacity to solve problems that are really outside your remit?
Well, and that's exactly right. And I think we've made the decision that we want to do these listening events, and sometimes the challenges that we hear about in particular committee or particular groups, we say at these meetings, that is not in our toolkit, that's not in our remit from Congress. But the fact that that is not the case doesn't mean we shouldn't be listening to those views and explaining our own perspective on it. So it works both ways.
Obviously, the U.S. economy is a part of the global economy. 46% of the S&P 500 earnings come from abroad. What do you see outside the U.S. that causes you concern? I just look at the GFSR from the fund yesterday.
Yeah.
They worry about corporate debt. They worry about sovereign financial nexus in the EU, China's financial imbalances, volatile flows, the EMs, all the things that we cover at the IF.
Yeah.
What among this crowd worries you most?
Well, I'd point to a couple of things, not necessarily things that worry me, but that I just observed. First of all, in the global macro data, we have definitely had a slowing if you probably rewind the clock to a year ago in Washington at the April meetings, probably more optimism about growth. In fact, if you look at, for example, different surprise indexes of data flow, they've been trending down. So clearly we've had some disappointing data globally in the last year. That being said, I think part of what goes on in sentiment, among different folks, perhaps in markets, is not so much the hard data itself, but expectations. I think going into last year, there was a lot of optimism about a pickup in global growth. And right now, it looks to me that the most likely outcome is that global growth more or less returns by the end of this year or next year to what we've seen for maybe the past 5 or 6 years. I think in terms of what concerns people, there are a list of the typical challenges that you all study at the IF and others. Concerns about trade tensions, concerns about being relatively late in the business cycle. But again, I think the most likely scenario is this is a very unloved recovery. In the case of the U.S., it's been going on for 10 years, and I think you got to keep your eye on that perspective as well.
You've had a long career of understanding, studying, and spending time in global markets. You've traveled the world. Stan Fisher ahead of you, same. How important is the external environment to Fed policymaking today relative to maybe what it was 15 years ago?
I think that's a great point, Tim, because before I took on this position, I was a student of global monetary policy. And I think it is a factor. The U.S. is a relatively closed economy if you look at the share of international trade. But that's a bit misleading because we're very integrated in global capital markets. And when the global economy slows down, we see it in our data. We see that exports decline. If there are uncertainties or turbulence in global markets, it tends to spill over into our markets in a range of ways. And so as I indicated in a recent speech at the Banque de France, at the Fed, we're very clear we have a domestic mandate. It's U.S. inflation and U.S. employment. But to achieve that mandate, we have to be cognizant of and have our policy reflect international developments. And I think that the Fed, under prior chairs, has done that well, and we've been trying to continue that.
One of the issues that has arisen is Fed independence. And just yesterday, Ken Rogoff, who you know well, I know well, gave a set of remarks at the G30 occasional lecture entitled, "Is this the beginning of the end of central bank independence?" And his remarks wasn't quite as harrowing as the title would prescribe, but that got people in the seats. How do you see the Fed's independence given what appears to be political persuasion trying to guide policy from outside the building?
Obviously, I think that's a very important issue, so let me give you my thoughts on that, Tim. First and foremost, it's important to understand that the Fed's mandate is assigned to it by the Congress. The Fed is a creation of the U.S. Congress by statute, and we have a very clear, in black and white mandate assigned to us by the Congress, which is maximum employment and price stability. The Fed, like many central banks around the world, has a degree of operational independence in that we get to decide on the setting of our policy instruments in order to achieve those mandates. But we are accountable. We are accountable to the Congress through hearings, through frequent visits. Chair Powell's been up on the Hill a number of times, and myself and the other governors make a lot of visits. And we're also accountable through our communications to the public and should and are evaluated on can we achieve and are we achieving that mandate. Now, let me say to you, Tim, monetary policy is more of an art than a science, and at any point in time, there are going to be a range of well thought and honest disagreement about the appropriate path for policy. We understand that. But the way that the Fed is set up is very important. At every meeting at full strength, there are 19 people around that table, 12 of whom vote. And most of the people around that table, the 12 Reserve Bank presidents, are appointed by their local boards of directors, so they reflect the geography of the country. And together with the governors, we are voting on monetary policy. And so I can say that in the 6 months I've been doing that, Tim, we have excellent staff, professional staff that gives us arm's length, unbiased analysis of the economy, and we make decisions on that basis alone. And politics just doesn't come into it.
But this is not new. I was in Bush 41 with French Hill was up here, Jay Powell and others. Yeah. And Nick Brady used to go out on a regular basis and complain about Alan Greenspan getting rates down. So we've seen this throughout, but It was quiet for a while during the 90s. It's not unusual for policymakers, whether it's the Secretary of the Treasury, the President, to have a view about policy, right? So it's just you have to let it go by you.
Yes.
All right, good answer.
And it has the virtue of being true.
And do you think current policy is neutral, accommodative, or restrictive?
So what we've said is that the current setting of the federal funds rate in a range of 2.25% to 2.5% is in the range of estimates of the neutral level. Indeed, it's in the range of estimates of a number of members of the Committee of Long-Run Neutral. Now, let me just say at the outset, the neutral rate of interest is an important concept for monetary policy, but it is unobserved. Right. We can't look it up in a textbook. We have to infer it from the data. But to give you some evidence that we're in the vicinity of neutral, with the funds rate right here, we have inflation around our objective. We have the economy operating now with a low but pretty stable unemployment rate. The unemployment rate's been more or less in this range now for about a year. And we've also said, Tim, and I've said in some of my own comments, that we need to be data dependent. And data dependent not just in the sense of finding out where the economy is today, but also looking hard at the data to see if we are in the range of neutral. So we're not doctrinaire about this. We're going to be looking at the inflation data and the growth data, and we're going to be taking our lead from that. Now, that said, 3 years ago, the policy rate was at 0, and I think everyone knew that 0 was not neutral. So it made sense to normalize. That process began under Chair Yellen. It's continued under Chair Powell. But we're a long way away from 0 now, and we're in the range of estimates of neutral, and that's why we've said that we think the economy's in a good place, and we can be patient meeting by meeting as we assess what adjustments might be needed to the policy rate.
The standard textbook rule of thumb is that policy operates with about an 18-month lag.
Yeah.
Is that still your view? And if that's the case, how do you think about data now, given where you need to be in 18 months? And to project in 18 months, you have to have some model of where you think that data is going to take your metrics.
And I think you phrased it exactly the way I think about it, Tim, which is, like many things, we owe this to Milton Friedman, who came up with the phrase long and variable lags of monetary policy. So we do have to take that into account. And the challenge that we and other policymakers face is we have to make decisions now based upon where the economy is going to be in a year or so. But that requires a model, that requires some forecast. One thing that I've argued in recent comments, and it's certainly not original to me, is you also want to be looking, you don't want to be handcuffed to, but you want to be looking at financial market signals. So, for example, we have an inflation index bond market in the U.S., and that can give you some noisy information, for example, about inflation. Now, again, you can't just read the so-called break-even inflation rate as a direct read on expectations, because there are liquidity and other factors. But certainly you don't want to ignore that information as well.
And you have a set of statistics. Alan Greenspan used to talk about railroad loadings. Our friends in China have electricity usage. Are there things, you have to tell us what they are, but are there 3 or 4 metrics that are really important to you that you think are important signals of where the economy is going?
Well, I've mentioned the break-evens. I think, but both in my time at the board and with prior experience, again, markets can move up and down for a variety of ways, but you tend to look at trends in those as telling you something about underlying trends. Tim, one thing I'll also say is I've become, in recent years, much more of a fan of looking at a lot of survey evidence. In fact, there was just a piece this week up on the NBER webpage, which I don't need to promote, by respected economist Andre Schleifer, who's known as a theorist, and he's basically making the case that economists have ignored surveys at their peril for the last couple of decades. So I look at a lot of different surveys of sentiment, look at surveys of growth and employment and expectations. And again, you don't want to be handcuffed to any individual survey, but taken together, I think they can be a useful complement to the traditional macro data.
The U.S. economy is predominantly services, more and more intangibles. I think manufacturing is about 10% of GDP, about 8 or 9% of employment. Do we spend too much time thinking about inventory cycles and the real economy and PMIs and not enough about services, and maybe it has a different cycle with a services-based economy? Maybe an output gap that looks very different?
I think that's very relevant. And Tim, I think that's especially true with traditional indicators of the stage of the cycle, because they really, in some cases, date from the 1940s and 50s when we had a manufacturing-based closed economy. And so I agree with you. I think, and in particular, another challenge, of course, Tim, with services is that it's more difficult to measure prices a lot of times in the service sector. You know, you buy a ton of steel, you know what, or you buy a car, you know how much that costs, but a service is typically bundled together, the price and the quantity, so it can be difficult, I think, in terms of price measurement too.
I have a graph I take with me around the world that looks at the tradable sector versus the non-tradable sector. The prices in the tradable sector have gone down precipitously over the last 20 years. The non-tradable sector, healthcare, childcare, education. How do you think about a bifurcated economy, those sectors where we see a real increase in prices, and might that have an overweighted effect on the overall price level?
Well, and I think that disaggregation is key, and that's a chart that I look at frequently now. So in a year when U.S. inflation is running around 2%, in most years in the last couple of decades, what that's meant is that the price of goods has been falling about 0.5% a year, and the price of services has been growing about 2.8 or 2.9. So the way we get to 2% overall inflation is with either flat or modestly declining goods prices and above average services prices. So you need to be cognizant of that as well, absolutely.
But that's one of the benefits of the tradable sector, right? Consumers have benefited from cheaper prices, and you could have greater choice in appliances and textiles, and electronics. If trade policy were to thwart or somehow inhibit that tradable sector, there would be a price response, wouldn't there?
Oh, sure. But that would depend on the details. What I'll say about that, Tim, is right now, looking at what has been put in place, it has, the trade tariffs put in place so far have had a really modest impact on what we've seen in inflation or growth. Obviously, there are scenarios that would be very concerning. Certainly my hope is that, these trade discussions now result in a positive outcome. And that would be great. If it doesn't, that's something we'd have to factor in. But what I can say is thus far, it's not been a big deal for the economy.
But you have mentioned it in your minutes before. The chairman has spoken about trade. Is that an issue you hear about when you're on your listening tour? Do people express concerns about where we're going with trade and potential sand in the gears of the global trading system?
Yeah, you do hear that. In particular, we hear that from our Reserve Bank presidents in their districts when they're talking to their contacts as well. Again, I think more in terms of things that would be of concern if this is not resolved in a favorable way.
Going back to Fed independence, Ken said something interesting yesterday, that we've relied on central banks to do too much, that fiscal authorities, that legislatures, parliaments should be doing more with respect to counter-cyclical policy, but there's a timing problem and a consensus problem. Are we too reliant on central banks to solve our problems? And in some ways, expecting you to do too much, we hold you to a level of accountability or standards that are really sort of superhuman?
Well, I won't get into superhuman, or I'll confess that I'm not. But what I would say, though, is, and I think it's been my observation before I began at the Fed in September, I think this has generally been the case maybe for the past decade. The only game in town sort of issue. And again, there are complexities, as you mentioned. From our perspective at the Fed, we take fiscal policy as a given. We don't get involved in advising on it or thinking about it, other than when we're doing our projection, we have projections for what fiscal policies is going to be going forward.
But the U.S. Treasury or any financial agent could go out in the market and buy treasuries, right? They could do with the U.S. government balance sheet the same thing you're doing. It's one balance sheet. It's called the U.S. government. You just have a subsidiary of that. Why couldn't fiscal authorities do the same thing you're doing with respect to quantitative easing?
Well, again, that's certainly something that they might consider. But again, we just take their stance as a given, and then do our policy based on that.
You mentioned fiscal policy. We're running deficits of close to $1 trillion. 4.5% of GDP. We're at the top of the cycle. I travel around the world. I have a whole chart show on debt accumulation in this cycle, sovereign, household, corporate, globally, emerging markets, developing markets. We've really levered up in this cycle, and no one cares. Why are we so relaxed about the amount of leverage we've seen, the amount of run-up in debt, and why do you think the long-term yields aren't reflecting greater concern about U.S. fiscal trajectory?
Well, I think here you have to distinguish between the situation in the U.S. and in most other countries. As you and I have discussed, going back to when we first met nearly 20 years ago, as the provider of the global reserve currency, the U.S. does have a privilege. It's been called the exorbitant privilege. Folks want to hold treasuries for liquidity and for safety, and that means that we are able to issue those at rates that probably other countries can't. So I think the circumstance in the U.S. is different in that regard. But I think globally, broadly, you're exactly correct. We've had a huge increase in debt ratios, both sovereign and private, in the last decade. Of course, one of the reasons, getting back to our conversation a moment ago, that appears to be sustained right now is that the overall level of safe, riskless rates has been declining. But that's not going away, certainly, and longer term, that's got to be a factor.
And are there demographic components to the demand for riskless or long-term assets like treasuries that may be somehow influencing the price of yields?
Oh, absolutely. It's again, different range of estimates out there. But I think, Tim, the combination of demographics in which, as individuals get older in their life cycle, they tend to, and appropriately, shift into more conservative portfolios, more fixed income based, less equity based. And there are a lot of rules of thumb along that. Secondly, Tim, and this is something I became aware of before I joined the Fed, looking at a lot of screens, is the success of monetary policy has something to do with that as well. When I was beginning my career in the early 1980s, inflation was 12%. Paul Volcker, one of my heroes, slayed inflation. But ultimately, by the 1990s, treasuries essentially could be viewed, and indeed empirically turned out to be, a good hedge for equity risk, because when the economy went south, bond yields went down, and when the economy was doing fine, bond yields tended to go up. And so what finance folks call the hedging demand for treasuries is an important reason why treasury yields have been trending lower over the last 20 years. In some sense, because the Fed and other central banks have been doing their job, they've made bonds a more attractive asset.
You mentioned that in 1982, I went to buy this was beautiful little red convertible I wanted. I was 20
I hope you still have it.
And I went to the bank I didn't buy it. I went to the bank and they wanted to charge me 21% interest. So, and I thought, I wanted it badly, and I was young and I was foolish, and I thought, I almost bought it. But but that tells you there's a whole generation that's grown up that don't remember interest rates and inflation at those levels. So does that impact expectations, in the sense that we've had inflation so quiescent for so long that it's just built into expectations?
And it is. And I think that both academic research and observation suggests that that's one reason why in most major economies in the world, if anything, the challenge of the last 5 or 7 years has been the inability for inflation rates to move up towards desired levels. Central banks in many cases cut rates to zero or below zero and engaged in quantitative easing and other programs. And the textbooks that you and I read 20 years ago would have said there might have been some more inflation than the 2% that we've gotten. So after the fact, I think one of the factors that has limited actual inflation has been that realized inflation has been low for so long, expected inflation is low, and it's hard to get actual inflation above expected inflation.
So there's a Phillips curve dead, or our textbook's wrong?
The Phillips curve is not dead, but it has changed in important ways. The slope is flatter, and I think that people began to observe that even before the crisis. I think globalization has been an enormous factor, flattening Phillips curves compared to where they were in the 60s and 70s. You just think about it. In a booming economy, if you're closed, that demand's got to show up in prices. In an open economy, if you're booming, there's a trade channel as well, sort of a safety valve. So I think the slope of the Phillips curve is flatter, and I think the intercept, at least in the U.S., is shifting down because of this decline in the NIRA. If you look at the Fed's own estimates of what we call U-star, 6 or 7 years ago, they were close to 5 or above 5, and now the Fed's median estimate is below 4. Median estimate is below 4.5. So that's another factor.
And so you could argue that the openness, the trading sector, the tradable sector we talked about, being able to move production anywhere in the world if you're a large corporation, in some ways you can escape the closed economy trap of the domestic labor.
Sure. Yeah. So, and that's true not just here, but globally. As we've had more globalization and we have more exposure to trade, there's been a downward, across countries, a flattening of the Phillips curve relationship.
Productivity is another enigma. Every time I see Marty Feldstein, he tells me the measures of productivity are underestimated. What is your view? And if it is underestimated, by how much?
Well, of course, Marty knows much more about that than I do, and there perhaps is a measurement error. I think other experts essentially would point out that there's always been some measurement error, and it's not clear that it's any worse than it has been historically. I guess intuitively it does seem that a lot of the innovation and a lot of the products that we use every day, that we're probably not measuring that productivity as well. What I would say on productivity, Tim, is that certainly 2018 was a good year for productivity in the U.S. Business sector productivity was up around 2%. 2018 was also a good year for labor force participation. So, in any macroeconomy, there's a demand and supply side. But last year, we had a supply side increase both in productivity and labor force participation.
And might tax cuts or tax reform have played into that?
Well, I think certainly it could. I think honestly, it's probably a little bit too soon to tell. Look, this was the most significant reform to the corporate tax code perhaps since Kennedy back in the 60s. Remember the 88 legislation more on the consumer side.
Right.
And so I think the fair answer is it's too soon to tell. But certainly, the intent of the legislation was to encourage investment.
And you would expect to see business investment and other forms of investment pick up over time, which would help on the supply side.
Right, it does, yeah.
You mentioned earlier about the dual mandate. But one mandate that the Fed and other central banks have been given since the crisis is financial stability.
Yeah.
So how do you think about financial vulnerability, financial stability? You don't have additional tools. How do you incorporate that into the way you think about the Fed's approach?
Yeah. Well, that's a good point. And the way that we would think about it broadly, Tim, is that there will be certain, at many points in the cycle, our dual mandate objectives and our observations about financial stability work in the same direction. So booming economy above capacity, markets may be doing well. Depressed economy below target, markets not doing so. But as the Fed has said for a number of years, and certainly we've been saying that our primary desire is to think of using the policy rate, the federal funds rate, as the primary tool to achieve our dual mandate employment inflation objectives, and to use other means such as macroprudential tools to achieve the goals for financial stability. Now, that being said, Tim, and I've commented many times publicly, I think with regards to financial stability, it's important to remember that this is an area where probably one size does not fit all. A set of macroprudential tools that could work in continental Europe or Japan might not work well here, simply because our capital market is much different, much more credits intermediated outside of the banking sector through securitization. And so that doesn't mean that we don't have tools, but they're of a different nature perhaps than in another sort of financial system.
So are there particular parts of the financial spectrum that are worthy of additional scrutiny? We talk about leveraged lending, student loans, there's subprime autos. Are there pieces of the financial intermediation spectrum that you think we should be paying more attention to?
Well, what I would say on that is one of the things that has been undertaken at the Powell Fed is, for the first time, the Fed is now publishing semi-annually, twice a year, a financial stability report, and the first one was issued in November, and another one will be issued in the spring. So I don't want to get too far ahead of that report, but certainly that is something that we now publicly report on twice a year.
And if risk is just being moved out of the deposit-taking institutions, which you oversee, to shadow banking, I don't like the phrase, but let's call it market-based financing, to your point, is it tougher to see, tougher to regulate, tougher to analyze, and therefore more of a potential risk going forward?
Well, the way I would characterize it, Tim, is I think the broad thrust in the U.S. of financial, and particular banking regulation and supervision since the crisis has really been to focus on the capital levels of systemically important institutions, and importantly, and for the first time, their liquidity holdings. And there are lots of terms of art, high-quality liquid assets. But banks have a lot more capital. They have much more liquidity. And so in the areas over which the Fed has primary responsibility, which is U.S. bank holding companies and systemically important institutions, the focus has really been on looking at both sides of that balance sheet to make them very robust, acknowledging that there are parts of finance that operate outside of the banking system.
We've heard from some of the CEOs yesterday note the fact that we've seen greater volatility in the corporate bond market because of the lack of capacity for those large firms to make markets, that they simply don't have the balance sheet because of regulatory reasons. Do you worry about that, the major G-SIB's capacity to make markets in corporate bonds?
I wouldn't say I worry of it, but I am aware of the data, and the data is clearly that before the crisis, there was a lot more, if you will, inventory that were being held at major financial institutions that facilitated two-way trade in corporate bonds. And for a variety of reasons, that inventory is much reduced, and those markets have expanded, and so that has had implications for liquidity. So I wouldn't say I worry about it, but it's certainly something that we're aware of.
I know you're very busy. You've got a whole host of bilats over the next few days. The town is full of guests from out of town. You've been generous with your time today. I will say it's a great CD. We don't have them for sale, but I'm sure they're available somewhere. Great music, and I want to thank you for all that you do. Thank you very much.
Thank you, Tim.